Hello everybody, welcome back to Sectors Made Simple and to another lovely Friday. Today we are going to be continuing our Step into Sectors series with episode number 5. Before we get into that, I do want to make a couple of quick announcements. For all of you that were able to join us this week, earlier this week we launched the beginning of our Inversores en Opciones webinar series. This is a Spanish language series that we are running to give you the opportunity to learn about options and have a support group to learn alongside. We have divided up that group into 2 Facebook groups. We have the Principal group, which is the main group, and then we have the Repaso group, which is meant for more review. Now, we've gotten a few emails from people asking for us to be able to go back to the beginning and make sure that the foundation, that everyone is all ready to go. And some people that felt like the first few webinars that we've done surrounding the series have still been a little too advanced. Don't worry, we've heard you, and next week we will be doing a special webinar to make sure that everyone has the foundation they need ready to be able to take the series and fully enjoy it. So no one will feel left out, no one will get left behind, and we are very excited to be able to provide that series for you. So, if you haven't checked it out already, head on over to our Facebook page where you can watch the first 2 live trading sessions from that series, and if you are a Sectors Made Simple subscriber, you can head on over to the Learn site to watch episode number 1 of Inversores en Opciones. But for today, we are here to talk about Step into Sectors. So today is going to be webinar number 5, and I've planned this one out to be a lot faster of a webinar. We're not going to have huge takeaways today that you can immediately start using to invest. Today's going to be a little bit more setup. So because of that, I want to be conscious of our time and not take as long to get through this information. So let's get straight into what I have planned for you all today with our disclaimer. As usual, everything we talk about today is meant for educational purposes only. These are not trading strategies that are promising returns. We are not promising anything. We are not making recommendations. Everything we talk about is analysis of past data and current data to try and figure out what might happen in the future. But past results never guarantee future performance, so it is always important to do your own research prior to making any investment decisions. So, today we are on to step number 5 in Step into Sectors. So today we're going to take the matrix strategies that we've talked about for the first 4 episodes of the series and put them aside. We've talked about a lot there, and I don't want to get too advanced. Those classes I feel like have already gone far enough. Today, I wanted to take a sidestep almost and talk about something else. So today we're going to talk about one of the main reasons why investors use relative strength. So the main reason is that it's really helpful at helping us to know what part of the market is doing the best at any given time. So today, again, we're going to keep things nice and simple. We're going to focus on answering a few questions, just like we do for all of these episodes. And in the coming weeks, we will go into much more detail about what we've covered today. But before we get into this, let's put a bookend on everything that we've talked about up to this point and review lesson number 4. So in part 4, we finished up our SMS matrix strategies by talking about how to export strategy backtests and import them into Google Sheets for analysis. We talked about some key metrics or pieces of information that we could calculate using Google Sheets and how those different calculations can be used for our investing. Some will tell us how well the strategy is done. Others will tell us what the worst it's done is. Others will try and tell us how consistent it is. And others will try and tell us a little bit more about how often the strategy wins and loses. And then finally, we ended that webinar by sharing a template with you. That template, you can copy and paste in backtesting results to be able to see with your strategy all of the different metrics that we covered in that class. So, here are the questions that we will answer in today's webinar. Why does relative strength matter? What is the difference between short-term and long-term strength? What do all the little symbols on the matrix actually mean? How can we use the matrix to find the leading sector in the short term and long term? Are there any other ways of finding leading sectors using the matrix and sectors made simple? And most importantly, why should I care? How can I use this information to invest? Let's get started off by answering the simplest question. Why does relative strength matter? Well, simple. Every single investor will be left having to make decisions. Decisions of when to buy a company, which company to buy. There are so many reasons that comparing two different securities or companies is an important skill for us to have. Relative strength, or RS as it's abbreviated, is one very common way to do this. We're going to avoid all of the math here and just talk about the idea of relative strength. I have company A, and I want to see how well company A is doing compared to company B. You are looking at A, then looking over at B, and you're using A as the role model. You're looking at A and saying, how are you better, or how are you worse than him, or them? You're constantly looking at how A is compared to B. Now that is important because something else we can do is compare B to A. And that might seem straightforward, right? Imagine you take me and my mom. You look at me and say, how does Jonathan compare to Julie? Well, his skin is a little bit lighter. So Jonathan's skin is lighter than Julie's. Jonathan's hair is darker than Julie's, and Jonathan's hair is shorter than Julie's. But Jonathan, I know you can't tell from the camera, Jonathan is a little bit taller than her. Now, that is comparing Jonathan to Julie. Let's flip it, though. We're not going to say now that Julie is taller than Jonathan, Julie's hair is darker. We're going to flip all of those. We're going to say Julie is shorter than Jonathan. Julie has darker skin than Jonathan. Julie has lighter hair than Jonathan. So we're now comparing one thing to the other. And the order here matters. If you're comparing me to her, I will be taller. If you're comparing her to me, she'll be not as tall. It's little things like that that make relative strength useful, but makes it important that we are putting them in the correct order. So here we are talking about A compared to B. We also can do B compared to A, but it's not going to be exactly the same. We're not going to have the same answers. The answers are going to be a little bit different. But let's just focus on A to B. What we can do is we can divide the price of A by the price of B and get a number. And we can track how that number, the A to B comparison, changes over time. If that number gets bigger, that means that A is gaining strength over time. Let's do a little bit of basic math here. If we have the price of A is $100, the price of B is $10. Our number is 10. If A goes up, that means that A is gaining strength compared to B, so it should go up as well. So if the number is getting bigger, A is gaining strength over B. If this number gets smaller, or this number gets bigger, we see how that number gets smaller. So if the number is getting bigger, A is gaining strength over B. If the number gets smaller, A is losing strength compared to B. That's all you really need to think about for today, and we're going to leave it here for now. If you want the full context and full walkthrough of relative strength, as well as how we actually take that number and turn it into the matrix, I highly recommend you go and check out our series, Back to Basics. If you're not sure where to find that, we have our webinar site, sectorsmadesimple.com. And under courses, it's the very first course you will see. You do not need a subscription to come here. So all you need is a free account with Sectors Made Simple to be able to check out this course. The Back to Basics, Point and Figure, and Relative Strength webinars will teach you what we just covered in much more detail with the real explanation. Right now, all you need to think about is relative strength is comparing two things together. Comparing how A is compared to B. That's it. So, with that in mind, let's tackle the next question. How do we turn that number into short and long-term strength? For this, it's a little bit more difficult, but we can make it simple. Short term is what direction is it going? Is it going up or is it going down? That's it. Long term is the direction of its trend, positive or negative. Think about it like this. Think about it like the wind. I'm trying to throw a little wiffle ball, and there's a bunch of wind. The short term is the direction that I throw the ball. If I throw the ball and the wind is coming at me, which the wind is the trend, the ball is going to start going, slow down, and then eventually start going backwards. So, the short term can change very quickly. I can throw the ball this way, I can throw the ball that way, I can throw the ball that way. The long-term trend is a little bit harder to change. That's the wind. That will change over time, but it's not as easy to change. And it takes a lot more for the wind to change than it does for the direction of the wiffle ball to change. But they do work together. They are telling the same story. What direction is the ball going? And that is how we can think about relative strength. The direction is up or down. Is the value, that A to B, is that going up or down? And if it's going up, is it speeding up, slowing down? What is the trend? What is the current? What is the wind behind it? Again, if you want all of the details, we have all of those for you over in Back to Basics. For today, we're going to keep it simple and tell you that everything we just talked about is all done for you. You don't need to do any of it. What you do need to know is that the matrix, that thing that you open up when you go and do a matrix strategy, it is made from relative strength charts. 132 of them. For every single one, we find if security A is in the up or down direction, or a positive or negative trend. Those same things we just talked about, we do automatically. Direction, we represent as X's or O's. X's are up, O's are down. And trend is a little bit more straightforward. P is for a positive trend, N is for a negative trend. For every single sector ETF, we do 13 different charts. Rather, not 13, should be 11 different charts. And then we add them all up together, and that is how we make the matrix. So let's take a look together here, and let's look at the matrix and see if we can find what I'm talking about. Let's take XLB. XLB compared to the S&P 500 SPY. O, downward direction, and N, negative trend. Let's compare XLB to XLRE. X, positive direction, up direction, P, positive trend. How about XLB versus XLE? X, up direction, N, negative long-term trend. So the trends aren't always going to agree with the directions, and that's okay. What we want us to know, though, is where is it short-term? X or O, up or down. Where is it long-term? Positive or negative, E or N. We do all of the comparisons, so it should be 11 per, not 12. And then we can start to put that into context. We add up all of those X's and P's. So if we go through and count the X's, 1, 2, 1, 2, 3, 4, 5, 6. We get an X count total of 6. Let's now go through and count the P's. 1, 2, 3, 4, 5, 6. So positive trend count is 6. So X count tells us the short-term total. Positive trend is the long-term total. And we can see very, very quickly some sectors like XLP or XLRE or XLU have a lot more N's and O's than something like XLC that has only 1 O and 2 N's. With this, you are starting to be able to see that all of this stuff on the side here is cool to know, but these numbers are what actually matter, and now you understand where they come from. If you followed the first 4 lessons of Step into Sectors, you should already be familiar with this, because you probably used that and momentum for strategy trades. This is the data that we used for the strategies. That before I said, don't worry about what the numbers are, these are what the numbers are. Today, we get to explain why those numbers are there. But let's now take your strategies and think about them and think, what are the strategies doing? because I don't want you to just think, this strategy works. Why? I don't know. I just pick that number, and it does the thing. I want you to know why. Why are those numbers working? Well, let's look at our X count momentum. X count momentum, we are looking for the sector that has had the most short-term growth over the last 2 weeks. Remember, momentum looks at how the matrix has changed over time, and we just learned that X count is our up or down total. So it is the number of ups that we have for each sector. So if what we're looking for is a sector that has an X count total of 2 or more, technology, for example, it went from an X count of 5 to an X count of 8. It's gained short-term strength. So what that strategy is doing is it is buying the sector that has short-term growth. It is growing in the short term. But it also looks at total count. Total count is just positive plus X count. So all that's saying is give me the strongest sector. Not short term, not long term, just the strongest sector. So now, put the two things together. What was the strategy that we covered in Step into Sectors number 1 doing? We are looking for the strongest overall sector that has some, X count of 2 or more for momentum, has some short-term strength growth. That's all it's doing. Let's now take the strategy that we covered in lesson number 3. Positive trend momentum. Look for the sector that has had the most long-term growth over the past 2 weeks. That's all it is. But now that you know that, it should make sense. We're not just randomly putting numbers out there. We are looking for the strongest sector that has some short-term growth, or we are looking for the sector that has the most long-term growth over the past 2 weeks. These are real reasons. These are the reasons that the strategy works, and the reason that I feel so comfortable talking about these strategies. They aren't just random numbers that have gotten lucky at doing well. The reason that we use them makes sense. So now, that's the last I want to talk about the matrix strategies. The rest of today I want to dedicate to finding the leading sector. And this part here, again, I'm going to spoil it right now. There's not going to be some magic solution at the end of today where this information revolutionizes how you invest. We will introduce the idea today, and then in the coming weeks, we will get to explore that idea with actual strategies. But for today, I want to introduce you to using this information to find leading sectors. So, how do you find a leading sector? Using the matrix? Just look at the matrix. The leading sector for short-term strength would be the sector that has the highest X count. Excuse me. The sector with the highest long-term strength, or the most long-term strength, would be the sector that has the highest positive trend count. The leading sector overall would be the sector with the highest overall count. So, let's head on over and audience participation time. What sector has the highest short-term strength right now? What sector has the highest short-term strength right now? XLC. We can see, if I sort this by X count, that XLC has a total of 10. Second place would be XLK, Technology, with 8. And the lowest would be XLP, Staples, at 0. Now, what sector has the highest long-term strength? What sector has the most long-term strength here? Again, we have XLC. XLC has 9. XLK and XLE is energy, has 8. Then we have a 3-way tie for 4th between discretionary XLY, industrials XLI, and the S&P 500 SPY with 6. Finally, what sector has the highest overall count? I'm gonna just assume that you're gonna find out the answer, because if it has the highest short term and the highest long term, XLC is going to have the highest overall strength as well. 19 to Technology's 16 to XLV, which is Healthcare's 12. Now, here's something really interesting. I'm going to show you this right now, but if what I'm saying is a little much, don't worry. But this is where your mind can start to go when you're looking at this. It's very interesting when you find a sector that has really high positive trend and really low X count, because it usually means something is changing really, really fast. Check this out. XLE. Positive trend of 8. X count of 1. Very interesting. What does momentum have to say about it? Interesting. So, XLE last week had 11 more total count. So it has lost 10 X count and 1 positive trend in the past week. So last week it had 9, 11, and 20. This week it has 8, 1, and 9. That is a huge drop. But we only know that because we can look at the matrix and see that is weird. So I might keep an eye on XLE to see if this number now goes back down. Because again, short-term trends or short-term direction is a lot easier to change. It's the long-term that's harder. So the question is, next week, will we see XLE lose positive trend momentum and fall further down into the matrix? This same effect, though, could happen in reverse, where you see a sector have 1 positive trend and 8 X count. Now, all of a sudden, you're keeping an eye out, because that might be a sector that is about to gain a lot of positive trend strength when that long term catches up. So one great way of using the matrix is looking to find little times like this, where you see a sector that has a lot of 1 not a lot of another. Because usually, things will be pretty close. Even XLB is a fairly big difference. 3 is getting on the high end of what I would say is normal. But that is just one way of looking at the matrix and starting to study the market using this data. So, if you had to ask me, short term, long term, and overall, what's the strongest sector right now? Probably going to say communications. But there's one other way using our tools to find the leading sector. And for that, we get to move a little bit away from the matrix. Romulo, which count do you give more weight to? The short term or long term? If I am trading a momentum strat, I usually like to use short term momentum or long term just strength. So typically what I'll use is I'll use this positive trend column here, and for momentum I like to use the X count column here. Changes in short-term momentum to me are very interesting. Long-term leadership is also very interesting. But again, I also put a lot of weight on having a good balance. Something where you see 8 and 1, that's not a good sign to me. That is way too much imbalance. Something is changing really quickly, and I don't want to be stuck in the middle of that. For some people, if you're super interested in trading things that are moving very quickly, find things like this. Find opportunities that have huge differences in their relative strength scores. There's a lot of trading that can be done there. But for me, if I'm using relative strength, I typically like to do this for more passive and more long-term investing. So positive trend strength or X count momentum are usually the two things that I look at. So now, the last way of finding a leading sector will take us away from the matrix and towards another tool that I haven't introduced on the dashboard. It is called the S&P 500 screener. And there is a lot of stuff that it does, but the main goal is to give you a resource to use relative strength to buy companies. All of these things are sector ETFs. We wanted to make something for companies as well. If we head on over to the S&P 500 screener, it has a lot of information. We're going to ignore all of this today. We're going to scroll down, and the only thing we care about is the S&P 500 sector averages. What are these? That is the last slide of the entire presentation. What are these sector averages? Here we have to get a little bit of detail to give you a proper answer, but the matrix is what is known as market cap weighted. Bigger companies in those ETFs matter more. The Apples, the Amazons, and the Teslas of the world, they have a lot more impact. They weigh a lot more on the price of that sector ETF. So, if the really big companies in a sector don't do well, it's going to pull the entire sector down. Or if the big company does really, really well, it's going to pull the whole sector up. That's great if you're investing in sectors. But if what you're looking at is investing in companies, it's not perfect. Because you can make 5% return on the smallest company in the S&P 500, and it's the exact same as if you made 5% return on the biggest company in the S&P 500. It is still 5%. So, we wanted a different way of looking at relative strength. And what we did was we created the sector averages as what is known as an equal weighted index. The sector averages are equal weighted, meaning that it is just the average of the relative strength score for every company in its sector. So regardless of size, every company matters the exact same amount. We can read this the same way as we read the matrix. We can use X count and find what the leading sector is, because now the leading sector is a little bit different. We sort by X count, we find that technology has the highest sector average, with communication services, so technology, so we can make comparisons, is XLK. Communication services is XLC, while basic materials is XLB. Compare that. XLC, XLK, XLB. XLB is the big surprise here. That means that the big companies in XLB are dragging down the sector. But overall, basic materials has a lot of very strong companies within it. They're just not big enough to make a big impact on the price of XLB. Sort by positive trend, now we get 3 more answers. Technology, by the way, communication services, our previous leader, dropped down to 4th. We have technology, XLK, in 1st. Financials, XLF, in 2nd. With energy, no surprise there, still being in 3rd. But again, we notice that big difference between its positive trend and its X count. The information isn't going to change completely, but it's going to give us a different way of looking at leadership. And total count, technology on top, communication services in 2nd, financials in 3rd. What does that tell us? That technology is the strongest sector, but it is not the strongest sector on the matrix because some of the bigger companies in technology aren't doing as well as others. So the Microsofts and the Apples and the Intels, they might not be doing as well as some of the smaller companies in technology. But because the big guys matter so much more here, you're not going to see technology's leadership for what it really is. So, this is another way of looking to find sector leadership. But both of them are the same idea. X count, short-term strength. Bigger number, more strength. Positive trend, long-term strength. Bigger number, more strength. Total count, smack the two together and make them friends. The bigger the number, the stronger the sector. That's all this is. But when should you use one and when should you use the other? This leads into my talk about how can we use this information. And again, we'll go into much more detail about these ways in the future. But I personally use the matrix when I want to know what the leading sector is to be able to study the market. There's a lot of ways that you can use leading sectors to study not just our market, but our economy as well. There is such a thing as a market and economic cycle, with different sectors doing better or worse during different periods of that cycle. By studying the sector matrix, we can understand where in that cycle we are. I would also use the matrix when I want to invest in sector ETFs. Matrix strategy is one way of investing in sector ETFs. The other way, also just buy the sectors and hold them. You don't need to trade it every single week. So this is where, to Romulo's question, I might look and say, I'll buy the sector that has the most long-term strength. I'm investing in something, I want to just put my money there and forget about it for a little bit. I can put my money in in a sector that has high positive trend and check back in on it later. And then finally, we can use the matrix because it gives us momentum. It is a great way of seeing momentum to be able to see how relative strength and leadership in sectors has changed over time. Finally, we would use the S&P 500 sector averages, when what we're interested in is investing in individual companies, because now we don't care if it's the biggest or the smallest company. 5% return in one, 5% return in the other. So, give every company a fair chance. So I'd use that table if I'm investing in companies within sectors. I would also use it if I want an equal weighted leadership score. And finally, it is a point of comparison. Sometimes the matrix and the S&P averages will agree with each other and say, this is the leading sector. And then other times, they won't agree with each other. They'll take a sector like financial that is in the bottom half of the matrix and say, you know what? Financials isn't as bad as you think. The big companies in financials aren't doing well, and that's the reason that XLF is down in the bottom half of the matrix. But financials as a sector is not only in the top half of the matrix, it's the number 3 sector, number 2 for long-term strength. So if what you're looking at is companies, if you didn't have this table, you would have never known that financials is a sector with many strong companies to offer. You would only see that XLF is weak, and if we compare it to 1 week ago, it's had no change. So we can use the two pieces of information to compare and find areas of opportunity that we wouldn't have found otherwise if we didn't have this and this. And again, what we're doing here isn't crazy. If you don't know strategies to use this information, don't worry. Start just taking a look at it. If you have sectors made simple, this isn't some additional thing you need to buy. If you have sectors, you have all of this. It takes 5 minutes to go in, hit some buttons, sort the columns, and see what you find. Do you need to use the information right now? No. But the goal here is that you start to play with these tools bit by bit, and you start to understand the market more. Like, for example, why is financials number 3 overall, number 2 for positive trend, but so low on the matrix? Great question. You can explore that. Why is XLE so high in positive trend, but so low in X count? Oh wow, it lost a lot of momentum last week. Why? Go explore it and find out. The goal of these tools is for you to explore. We want to give you the information so that you can discover for yourself and go as far or as shallow as you want in figuring out more about the market. So, that is what I wanted to introduce you all to today. So, while today might have seemed basic, and I started to show you ways that you can start to get more detailed about things, the goal was that today was meant to be simpler. It was more about not so much taking a step forward in complexity. The first 4 webinars definitely were. Step 1, step 2 is more advanced, step 3 is more advanced, step 1, step 2, step 3, step 4 is more advanced. Step 5 was not another step up. I'd like to think about it as a step sideways. Let's take a step sideways, go back to square one, and talk about and explore something new. But now we have the basics out of the way, and we can really show you how you can start to learn to use relative strength for investing. And that brings us to what's coming up in the next episode of Step into Sectors. In part 6 of this series, we will look at how to use Sectors Made Simple to invest in individual companies using the S&P 500 screener. We will talk about how a stock screening filter works, how to use our stock screening filter for the S&P 500, and some ways that you can use the information from the screener to choose companies for investments. But that is what I had planned for you all today. Again, I wanted it to be a little bit shorter of a webinar, but hopefully one that gets you interested in exploring more about our tools. We really try and make our tools something that you can start to use with very little understanding of the full detail of how the tool works. We went 4 weeks of talking about matrix strategies before we ever actually explained how we get these numbers, what this demonic game of tic-tac-toe really is. It wasn't important. But now, if you're starting to ask questions, if you're starting to ask and want to learn more about this information and start to make your own investment decisions based on the data, you now are ready to go. So, hope you all can join us next Friday as we continue with step number 6 of our Step into Sectors series, where we start to talk about investing in companies using the S&P 500 screener. But until then, thank you all so much for joining us today. Have a great weekend. Hopefully you all have enjoyed the start of our Inversores en Opciones series, and if you'd like more information or to subscribe and join for that series, please send us an email at support@sectorsmadesimple.com. Thank you all so much. Hope to see you all back next week.